You may improve your trading with what I'm about to show you. Basically trading off two H4 candles and using the FVG, which means fair value gap, a concept that I am currently using in my trading entries, and I have been researching more on it. It is a non-subjective technique that leads to an entry with only 3 steps. So basically you are going to be building a cycle, and a cycle that is going to require 3 steps for you to get into the market. Everything worth doing requires patience and discipline, and remember, success doesn't come from intensity, it comes from persistence that is showing up even when it is hard. Trading is a difficult business, a very difficult one, and it doesn't pay those who are chancers. So be someone who is persistent for you to see real results from this particular business. This strategy is tradable on any asset on the H4 time frame and without indicators. You can as well trade it on the phone, and it has clear targets and clear exits that I'm going to show you. You can trade any asset of your choice because any asset, any tradable asset obeys what I'm about to show you. So what is the H2, H4 candle strategy? Let me explain. Someone may have seen something like this online, and they may say Bunnex is starting to copy, or I am actually trying to impersonate someone, but I'm trying to actually give you and simplify the concepts that I've been teaching from day one on this particular channel. So it is not something that I am going to add in what you already know, and you actually see the power of doing this. Alright, so basically what you are going to be requiring is, firstly, you're going to scout for an H4 fair value gap. This is going to act as the base of the market flow. By base of the market flow, we are saying whenever an H4 fair value gap is issued, we're going to be looking for sales. Basically, we are trying to wait for the market to come back within that particular point, and then we start to look for sales. But that is not the entry when we see the market coming to the fair value gap. For the purposes of those who do not know what a fair value gap is, it is basically a point whereby the market leaves a gap between the low and the high of the next candle, leaving one candle in between. This space from this high to this low of the second previous candlestick is what we call a fair value gap. So here's the arrangement of what you are going to be looking for. Firstly, we are going to say H4 fair value gap, which is this A. So on A, we are going to look for this gap between 2 candles, that is on H4 time frame. Then B, which is here, we want to see the market to come back to this particular fair value gap, and after coming to that fair value gap, we want to see the market to give us the H4 liquidity grab, whereby the H4 will actually break above this high of the previous candle. We are talking of these 2 candles, the red and the green one. When it breaks the high, like in this particular case, it broke the high, and see it closes right below the open, which is below this particular open, and it closes here. And then D, which is at this particular point, we now wait for a retracement to 50% of this particular candle in subject, and E, which is the stop loss of entry. When we actually make an entry at 50%, we want to set the stop loss right above the candle of interest, which is this one, and F is to find the 2R target. That is where we want to make an exit. This might not mean anything before I give much more explanation. So let's now dive into the steps that you are going to follow. We've said step 1 is to actually mark the fair value gap. We can see in this particular example, we have this high and we have this low. In this particular case, we can see this high and low, they are not meeting, or they are not interacting or intersecting, meaning that there was a gap in between these 2 candles. This is the fair value gap that I was going to define earlier on. So in this particular case, we can see the market came back to that particular fair value gap and retested that particular fair value gap. This retest actually gives us an idea of where the market might move next. This is where I am saying the FVG will be giving us a bias of the market. So in this particular case, we are expecting that the market is going to move up away from that fair value gap. So in terms of the market maker structure, we can say peaks peak formation lows or peak formation highs occurs at those FVGs. So step 2 is now to find the 2 H4 candle arrangement. So in that particular case, we want to find a candle that breaks the low and closes right above the open or the closing of the previous candle. So in this particular case, we had the FVG, that is tick. Step 1 has been satisfied. Move to this particular point, that is another tick. And then 3, we now want to see the H4 candle arrangement, which is basically what happened in this particular case. We can see these two candles. We can see this one grabbing the liquidity below this low of the previous candle and closing right above the high, which is also okay if it closes above the opening or closing price. So in this particular case, it was a tick. We've said at 50%, that is where we want to see the market retrace and hit, and then stop loss right below the structure to give us a 2-to-1 reward to risk ratio. So that is basically what I am going to show you here. We are saying it's basically FVG, retest of FVG, and then candle arrangement of the H4 to make it a 2 H4 candle arrangement. So let's now have examples, but before we do so, check out my free Telegram channel where I share free signals and I share free setups as well as trading advice. You can actually check using the link that I've left in the description box below. All right, so first one is USD CAD on the 19th of August 2025. You can actually go back and verify what we are talking here. It is the same example that we were talking about. We've said the first thing is actually to look for a fair value gap. After looking for a fair value gap, we can see retracement to that fair value gap, and then we can see shift from that particular fair value gap and give us the 2 candle H4 candle arrangement and an entry at 50% of this particular candle. We are saying the H4 range candle, the range of the H4 candle, that is where we want to measure 50%, and we can see it happened here, which is our entry, stop loss right below structure, and 2R as our target. We can see another example that also occurred on GBP USD. They are quite similar, but they are different, which also exhibit the same thing that I have been talking about. So basically what you are going to be requiring is to see an H4 FVG, move to that H4 FVG, and then we can actually go to the upside. So for the purposes of summary, we are saying H4 HVG is where most peak formation lows or peak formation highs occurs. That is for the purposes of my audience who are actually market maker traders. This is something that you can add, and this is something that you can actually see yourself improving how you have been spotting these market maker peaks to the upside or to the downside. So from that particular H4 peak, H1 peak, you want to actually get in when an H4 arrangement has been issued, which I've said there are 2 candles. We want 2 candles. This next candle to actually grab the liquidity below the previous, and then closes above this particular price. It doesn't matter if it closes below this high, but we want it to see it close above this high, this opening price or closing price, and then our entry at 50% of this particular candlestick range, right? So you just measure 50% of this candlestick range and you are done. Stop loss at 2R and take profit